Today, we're doing a complete breakdown of International Financial Reporting Standards 3. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying International Financial Reporting Standards, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before International Financial Reporting Standards 3, companies could obscure the true cost of mergers. A $100 million acquisition might show as far less. Now, International Financial Reporting Standards 3 mandates a transparent and consistent approach to reporting business combinations. You'll grasp how this standard ensures clarity and comparability for investors and stakeholders. International Financial Reporting Standards 3 emerged to tackle the chaos in accounting for mergers and acquisitions. Previously, firms used various methods, leading to inconsistency and investor confusion. This standard mandates a unified approach, ensuring all business combinations are reported transparently. For instance, whether it's a $10 million or $500 million merger, the accounting treatment remains consistent, providing clarity across financial statements. International Financial Reporting Standards 3 is crucial for any entity involved in business combinations after March 31, 2004. It applies to all companies adhering to international financial reporting standards, ensuring a global standard for financial reporting. The most critical requirement? The acquisition method for all business combinations. This ensures a uniform approach, eliminating national discrepancies and promoting international financial statement comparability. The acquisition method under International Financial Reporting Standards 3 requires precise recognition and measurement of acquired assets and liabilities. It calculates goodwill as the purchase price's excess over net identifiable assets fair value. This method captures the transaction's true economic substance, ensuring accurate financial representation. Understanding this is crucial for interviews, where demonstrating knowledge of International Financial Reporting Standards 3's core approach can set you apart. It's not just about numbers, it's about understanding the financial story. Understanding the scope of International Financial Reporting Standards 3 is crucial. A common mistake is assuming asset acquisitions are covered, but they're not. Interviewers often test candidates on these exclusions, making it vital to know what this standard truly applies to and what it doesn't. International Financial Reporting Standards 3 sets the rules for acquiring control over businesses, not just assets. It covers scenarios like acquiring a controlling interest in a company or merging two entities. For example, if a company buys a 60% share in another, that's a business combination under International Financial Reporting Standards 3. Interview traps often include asset acquisitions that aren't businesses or joint ventures. International Financial Reporting Standards 3 doesn't apply if you're simply buying assets like equipment or land without acquiring a business. Similarly, joint ventures fall outside this standard. Steering clear of such scenarios during interviews is wise. A business combination occurs when one company gains control over another. Imagine a scenario where Company A buys 80% of Company B's shares. By acquiring these shares, Company A now controls Company B's operations, making this transaction a business combination under International Financial Reporting Standards 3. The acquirer in a business combination is the entity that gains control over the acquiree. For instance, if Company X purchases 51% of Company Y's shares, Company X becomes the acquirer, controlling Company Y's strategic and operational decisions. This control defines the acquirer's role under International Financial Reporting Standards 3. Does International Financial Reporting Standards 3 apply when acquiring a company division that operates independently? Or when control is temporary through a short-term lease? These are classic interview traps. Understanding whether a set of assets functions as a business is crucial, as is knowing if operational separation affects control status. Imagine acquiring a company but missing $10 million in hidden liabilities. The acquisition method ensures all assets and liabilities are recognized, providing transparency. This method is the foundation of International Financial Reporting Standards 3, crucial for clear financial reporting in mergers and acquisitions. The acquisition method transforms how business combinations are reported, ensuring all components are transparent and accounted for. We'll follow Meridian Corporation's acquisition of a $10 million SaaS contract, detailing each step from identifying the acquirer to disclosing critical information. This journey highlights how the model captures every detail, ensuring no asset or liability goes unnoticed. Identifying the acquirer is crucial to understanding who controls the acquired assets and liabilities. For Meridian Corporation's $10 million SaaS contract, they gain control by acquiring future benefits from Acme Incorporated, marking them as the acquirer. Many confuse high payment with control, but International Financial Reporting Standards emphasizes control's role over cost. Identifying Meridian as the acquirer sets the stage for determining the acquisition date. The acquisition date marks when control officially transfers. For Meridian Corporation, it's the day they legally gain rights to Acme Incorporated software. Confusion often arises from equating payment dates with this date, but International Financial Reporting Standards clarifies it's when legal control changes hands. Knowing Meridian's control date directs the next step of recognizing assets and liabilities accurately. Recognition and measurement focus on fair value assessment. Meridian Corporation must account for Acme Incorporated's software and service liabilities at fair value. A common mistake is ignoring intangibles, like software licenses, which skews financials. International Financial Reporting Standards ensures completeness by mandating all identifiable assets and liabilities are recorded at fair value, setting up for goodwill calculation in the next step. Goodwill captures synergies beyond identify assets. Meridian Corporation calculates goodwill as any premium over the $10 million asset value from Acme. Missteps occur when fair values aren't accurately assessed, distorting balance sheets. International Financial Reporting Standards demands this calculation to ensure goodwill reflects actual economic advantages. This sets the stage for the final step: comprehensive disclosure of the business combination. Finalizing a business combination requires full transparency. Meridian Corporation must detail why acquiring Acme Incorporated benefits them and its financial effects. Incomplete disclosures risk misleading stakeholders about the transaction's strategic and financial impact. International Financial Reporting Standards mandates these disclosures to offer a clear view of the combination's rationale and outcomes. With this, Meridian's story from acquisition to disclosure is complete, ensuring stakeholders understand every facet. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. Understanding International Financial Reporting Standards 3's requirements ensures accurate valuation of acquired businesses, affecting both assets and liabilities. It's crucial for clarity in financial statements and informs stakeholders about the true value of acquisitions. Initial recognition under International Financial Reporting Standards 3 requires identifying and measuring all acquired assets and liabilities at fair value on acquisition date. This captures the true economic essence of the transaction. Contingent liabilities, often tricky, are included only when obligations are probable and measurable. Goodwill reflects excess purchase consideration, signaling potential future economic benefits. After initial recognition, assets and liabilities are generally measured at cost, unless another International Financial Reporting standard applies. Goodwill is not amortized, but must undergo annual impairment tests, safeguarding against value overstatement. Contingent liabilities require reassessment if circumstances change, ensuring balance sheet accuracy. Provisional amounts can be adjusted within the measurement period as more data about acquisition conditions becomes available. International Financial Reporting Standards 3 requires that identifiable assets and liabilities from acquisitions be clearly presented on the balance sheet. Goodwill stands out as a separate non-current asset, distinct from other intangibles, providing clarity to stakeholders. Detailed notes disclose fair value measurements, enhancing transparency and financial reporting. Proper classification aligns with business operation purposes, aiding investors in understanding strategic impacts. International Financial Reporting Standards 3 mandates disclosure of the business combination's rationale, aiding stakeholder understanding of strategic motives. Detailed information on acquired assets and liabilities ensures transparency on transaction scope. Revealing total consideration transferred, including fair value, offers insights into acquisition structure. Explaining goodwill of bargain purchase gains provides context on strategic advantages or unexpected value realizations, key for investor analysis. Imagine a CFO acquiring a startup for $10 million, paid via $7 million in cash and $3 million in shares. They allocate $3 million to tangible tech assets, $4 million to assumed liabilities, resulting in $3 million goodwill. Annual impairment tests prevent overstatement, protecting financial integrity. Detailed disclosures on acquisition rationale provide investors with insights into strategic alignment, particularly in tech enhancements. Meridian Corporation, a global powerhouse in automotive parts, acquires Innovate Limited for $5 million. This acquisition triggers a cascade of accounting events. Let's unravel how this complex transaction unfolds within the framework of International Financial Reporting Standards 3. The acquisition of Innovate Limited is recognized by debiting investment in subsidiary and crediting cash. International Financial Reporting Standards 3 mandates this to reflect the outflow of resources and the stake in Innovate Limited. This entry establishes the foundation for consolidating Innovate's financials into Meridian's books, impacting future revenues and expenses. International Financial Reporting Standards 3 requires the acquirer to recognize identifiable assets at fair value. For Meridian Corporation, this involves recording Innovate's assets, thus reducing the investment in subsidiary. This ensures a fair presentation of assets acquired, crucial for accurate subsequent financial analysis and reporting. Goodwill of $2 million arises as the excess of the acquisition cost over identifiable net assets. Under International Financial Reporting Standards 3, this goodwill represents the future economic benefits from assets not individually recognized. It's a vital intangible, impacting Meridian's balance sheet and future impairment assessments. Consolidating Innovate Limited's profit involves moving $500,000 to retained earnings, as prescribed by International Financial Reporting Standards 3. This entry captures the economic benefits from Innovate's operations, enhancing Meridian's earnings profile and providing a more comprehensive financial performance outlook. Goodwill impairment testing under International Financial Reporting Standards 3 identifies a $300,000 reduction in value, prompting an impairment loss entry. This recognizes the diminished future economic benefits, ensuring Meridian's assets aren't overstated, which is crucial for realistic financial health assessments. Amortization of $200,000 in identified intangibles is necessary to allocate the cost over useful life, as directed by International Financial Reporting Standards 3. This process aligns expenses with revenues generated, refining profit calculations, and supporting informed investment decisions. Fair value adjustments at year-end reveal a $100,000 asset appreciation. International Financial Reporting Standards 3 mandates such recalibrations to ensure financial statements mirror current market realities, enhancing transparency and reliability for investors and stakeholders. The disposal of Innovate Limited for $5,200,000 results in a $200,000 gain, reflecting a successful strategic divestment. International Financial Reporting Standards 3 requires accounting for gains, illuminating the disposal's financial impact and enhancing Meridian's liquidity and profit position. Every Big Four and investment bank interview on International Financial Reporting Standards 3 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. The acquisition method is the only method allowed under International Financial Reporting Standards 3 for business combinations. It requires identifying the acquirer, measuring the cost of the acquisition, and allocating the cost to the acquired assets and liabilities. Misunderstanding this can lead to incorrect asset valuation. Remember, the key is recognizing assets at fair value on the acquisition date. International Financial Reporting Standards 3 was developed to provide a single method for accounting for business combinations, ensuring consistency and transparency. Prior methods, like pooling of interests, obscured financial realities. This standard mandates recognizing goodwill and measuring assets at fair value, promoting clearer financial statements. Always remember, it eliminated alternative methods to streamline reporting. Goodwill is recorded as the excess of the acquisition cost over the fair value of net identifiable assets. It's crucial to exclude transaction costs from goodwill. For instance, if acquisition cost is $10 million and assets are valued at $8 million, Goodwill is $2 million. Always exclude any transaction costs to avoid inflated goodwill. Contingent liabilities must be recognized at fair value on acquisition date if they are a present obligation from past events, and their fair value can be reliably measured. Failing to recognize these can misstate liabilities. For example, a lawsuit with probable outcome should be recorded. Always evaluate legal and financial impacts thoroughly. The acquisition method requires recognizing assets and liabilities at fair value and recording any excess as goodwill. Pooling of interests combined book values without goodwill. This older method often masked financial realities. International Financial Reporting Standards 3 eliminated pooling to enhance transparency and comparability. Always explain how fair value enhances clarity in financial statements. The main difference is in the definition and treatment of common control transactions. Indian accounting standard allows pooling of interests from mergers of entities under common control, while International Financial Reporting Standards requires the acquisition method. This distinction can impact reported goodwill and asset valuation. Always highlight how Indian accounting standard can influence reported results differently. Control is defined as having power over the investee, exposure to variable returns, and the ability to use power to affect those returns. Misunderstanding can lead to incorrect classification of investments. For instance, owning more than 50% voting rights typically indicates control. Always ensure that control is evaluated beyond mere ownership. A transaction is a business combination if the acquirer gains control of a business. The acquired set must include inputs, processes, and the ability to create outputs. Misclassifying asset purchases as business combinations can misstate accounts. Always verify the presence of a business rather than mere assets for accurate reporting. Disclosures must include the acquirer's name, acquisition date, percentage of voting equity acquired, and primary reasons for the business combination. This ensures transparency in financial reporting. Ignoring these can lead to compliance issues. Always ensure disclosures provide insights into the acquisition's rationale and expected benefits for investors and analysts. International Financial Reporting Standards 3 excludes formations of joint ventures, acquisitions of assets or groups that don't constitute a business, and combinations under common control. Misunderstanding often arises from misclassifying asset purchases as business combinations. Always distinguish whether the acquisition provides control over a business or merely provides assets to ensure correct application. Mastering International Financial Reporting Standards 3 starts with understanding its core objective: transparency in business combinations. With defined scope excluding joint ventures, it clarifies key terms like business and control. Knowing these definitions sets a solid foundation. Goodwill is a crucial element, representing the excess of consideration over identifiable assets. Acquirers gain control, while acquirees are the entities acquired. A strong grasp of these basics enhances your International Financial Reporting Standards fluency. The acquisition method is central to International Financial Reporting Standards 3, focusing on identifying the acquirer and measuring assets and liabilities accurately. Consideration transferred includes all assets, liabilities, and equity interests given at fair value. Non-controlling interest can be measured at either fair value or proportionate share. Contingent considerations are initially recognized at fair value and remeasured each period. Identifiable assets and liabilities must be measured at fair values at the acquisition date. In interviews, knowing the nuances of International Financial Reporting Standards 3 can set you apart. Misidentifying the acquirer is a common pitfall that disrupts the acquisition method. Compared to U.S. generally accepted accounting principles, International Financial Reporting Standards has specific goodwill impairment testing. Comprehensive disclosure of acquired assets, liabilities, and goodwill is essential. Recognize contingent liabilities when a present obligation exists. Remember, restructuring costs aren't part of acquisition costs. Provisional fair values can be adjusted within a year, and any bargain purchase gain hits profit immediately. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.